Alright, so today I wanted to make a video on a stock I've never talked about before. First things first, if you get value out of this video, please like and subscribe. I really appreciate that. So this is MEDP Holdings, MEDP is the ticker symbol. Now, this is something that would be classified as a growth stock. And for people that know my style, I'm usually not a growth investor. I lean more to the value side, specifically like your dividend growth or dividend stocks are usually more on the value side of things, and that's usually the ones that I like. This company does not pay a dividend, but I think that it's too good to pass up. So first things first here, 11 billion, just under an $11 billion company, very nice free cash flow yield, 4.6%, the earnings yield 3.12. That's a little bit lower than I'd like, but that's a very strong free cash flow yield. That's something that's very important when you're looking at stocks. You want those yields to be, I would want it to be at least, ideally, at least 4%, preferably the higher the better. But for certain industries, it's going to be very hard to get a super high free cash flow yield, but that's kind of besides the point. So engages in the provision of outsourced clinical development services to the biotech, pharmaceutical, and medical device industry. It's focused on providing scientifically driven outsourced clinical development services to the biotech, pharma, and medical device industries. So they partner with those companies in the development of and execution of clinical trials. So they provide a lot of the devices that go into those trials. And one of the many reasons that I like this company is, I mean, for starters, that's an industry where there's going to be a lot of growth. I think a lot of the traditional healthcare areas are overrated, for lack of a better way of putting it, but I think that this is one of those areas that is very underrated. So let's get into this company. If we look at the insights here, profitability metrics are good. They're not great. I mean, a gross margin 28%, operating margin 18%, net margin 16%, free cash flow 24%. Those are all solid numbers. I'm very happy with those numbers. Management's doing a very good job. One thing that is good when it comes to this company is that a lot of these growthier companies, they pay a lot, sometimes an egregious amount of stock-based compensation. This company does not do that, which I like. And for people that don't know what that is essentially insiders getting paid in stock. And the reason that it's a bad thing is a lot of times these companies exist, the main reason to enrich the founders and the executives and whatnot, and especially in the biotech and those kind of areas that's very common. Current ratio is a little bit below 1, but this company is debt free. They have about $1 billion of debt on a $11 billion market cap, so I'm not concerned whatsoever with the balance sheet here. Growth, these numbers are very good, right? Very good growth numbers here. Every form, revenue increasing very good, gross profit very good, operating income, net income, operating cash flow, all those numbers are growing very well. Another important thing here, next year projected earnings 13%, next year projected revenue 18%. And the valuation here, based on its average PE, it's below its historical average PE, just barely. Based on its average price of free cash flow, it's also just below those. PE of 32, that's debatably high, but a price of free cash flow of 21 and change, that's not high. I mean, for a company that's growing as well as this company is as profitable it is, I don't think that's egregious by any means. So if we get into the financials here, this is kind of the bread and butter. If we look at revenue has grown extremely well. Going back a decade, it's grown every single year. For the year ending 2013, it was $272 million. For the year ending 2023, $1.9 billion. So very nice revenue growth. Same with gross profit, also grown extremely well. They basically tripled their gross profit. Net income also has gone from, I mean, back in 2014, 2015, they were actually negative when it came to earnings. Like, look at 2014, they lost $15 million. 2015, they lost $8 million. 2016, they turned a profit, $13 million. And then 2023, $282 million. So those numbers have grown extremely nicely. Same goes for earnings. Similar story there, obviously. And then another important thing too, a lot of these kind of growth stock companies, one of the ways that they keep things going, for lack of a better way of putting it, is by issuing shares. This company is not doing that. In fact, shares over the last decade have gone from 39 million and change outstanding to 31 and change. So shares have actually gone down. They're not buying back every single year though, consistently, but they have gone down, which is another very good thing here. Like I mentioned the balance sheet earlier, especially with higher rates, even though they're projected to go down, they're probably not going to go back down to where they were. You want to invest in companies that have strong balance sheets. You look at their current assets, 1.7, almost 1.7 billion. Current liabilities, just under $1 billion, right? So, and they have zero current debt either, right? Zero current debt. It's all down the road, which is good. That's another good thing too. So that's one of the other many things that I like here. When you look at the metrics, free cash flow margin has always been very strong with this company. They're always right around 20%. They're actually just over 20% now. Same goes for operating cash flow. Their operating margin is strong. Their net margin is strong. So very good there. When you look at their return on equity, return on invested capital, return on assets, all of those numbers, very good. And not only that, they've all grown extremely well over time. I mean, look at their return on equity. Back in 2014, they were negative. Now they're up to 50%. So that's extremely good growth there. And then arguably the holy grail here is free cash flow per share. And that number has gone from 2.36 back in the year ending 2013 to 12.46 the year ending 2023, which is very good. That's very good growth. So they don't pay a dividend, so obviously I'm not going to talk about that. Average analyst rating, about 18% above where they are right now. It looks like there's one analyst that thinks it's a tiny bit below. So analysts clearly are bullish. Take that for what you will. So again, I think it's fair to say we've established this as a fairly good company, or arguably a very good company. But the one question that remains is where would you buy it? Is it even worth buying? So let's look at their historical valuations and whatnot here. So over the last about 7 or 8 years roughly, they've grown earnings at 52% per year, free cash flow by 29, and operating cash flow by 27. Average PE about 34. They're currently just over 32. Average price to free cash flow about 21.3. They're currently at 22.49. And then based on operating cash flow, 17.84, 20.2. They've also grown their return on invested capital 61%. They've grown revenue 25% per year. Are they going to grow that fast over the next decade? I really doubt it. So we definitely need to temper our expectations. But if we go back to the last, let's say, 5 years here, they've still grown earnings at 35%, free cash flow 27%, operating cash flow 24%. If we go 3 years, they've actually grown about the same. So let's try and figure out, okay, how much are they worth? If we go based on free cash flow, and we assume they're going to grow 15% per year, which the average over the last 10 years is quite a bit higher than that. They're not even going to buy back shares. They're going to have the same amount of shares, which shares have gone down over the last decade. And they're going to trade for an 18 price to free cash flow. Well, this company is worth 29% more than it is right now, and you're going to return about 13%, just under 13% average per year. In my opinion, if anything, this is probably conservative. I obviously could be wrong. Just out of curiosity here, I haven't done this yet. Let's try doing it just based on earnings and see the number that we get. Let's say they grow earnings 13% per year. They don't buy back any shares, and they trade for a 25 PE, which is less than the historical average of around 32. That still means just based on those numbers, it's still actually slightly undervalued. You're still going to return over 10%. Let's say you buy them at a 30 PE, which is still less than their 5-year average and 10-year average. that means it's worth 22% more and you're going to return 12%. So I don't see any way, just based on what I'm seeing here, obviously I'm no expert, take it for what you will, it's just all my opinion, but based on my opinion here and based on the numbers that I'm punching in, this company is clearly at least a little bit undervalued, So that is why I am buying this company right now. And like I mentioned off the start there, this is a very good industry. Like, this is a growth industry. Like, given the amount of health issues that people are facing nowadays, these clinical trials, not only are they not going anywhere, they are going up. And that is a mistake that some people make. They think, oh, well, this product X is not going anywhere, therefore the company that makes it is going to do good. That's a fallacy, because that's not always true, right? I mean, I think it's fair to say that alcohol is not going anywhere. Does that mean that you should buy Budweiser? Or I'm just throwing out names there. No. So that's a fallacy that some people make that I think is not a good comparison. But if you have a name within that industry that is extremely profitable, that's performed well historically, that is projected to perform well historically, they've grown well, they have a strong balance sheet, management's clearly doing a good job, then that's when it's safe to draw that conclusion, at least in my opinion. So that is what I wanted to talk about today. Like I mentioned off the start there, if you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.